All right. So hello, and thank you all for joining us this evening for this presentation titled Keeping Your Home Protected When Insurance Options Are Limited and Expensive. You are Firewise community leaders and residents, FireSafe Council members and educators, primarily from Santa Clara and Santa Cruz counties and some from neighboring counties. This event is being hosted by the Southbay Firewise Partners email forum and the FireSafe Council of Santa Cruz County. For those of you who don't know me, my name is Lynn Sestak. I'm the moderator for this email forum, and I'm also a board member and a volunteer with the FireSafe Council of Santa Cruz County, where I do Firewise coaching. Tonight's topic is quite timely for many of you. With State Farm Insurance's recent announcement of home insurance non-renewals that will impact more than 30,000 homeowners in our area, many of us are keenly interested in learning more about our options. For Firewise recognized communities, we're hoping that designation provides some discount with whatever new insurance we obtain. Many of us are proactive in home hardening and defensible space and are curious if that's also an asset towards reducing our insurance premium. So we're grateful tonight for having Joel Locher from United Policyholders to be with us this evening to help educate us. The nonprofit United Policyholders is dedicated to helping consumers with their insurance coverage and claims issues. Joel previously worked at the California Department of Insurance for 35 years, so he brings a wealth of experience with him. So before I turn the mic over to Joel, a few housekeeping tidbits. We're recording this event, and I'll send the slides and the recording out to the email forum afterwards. Because this is a Zoom webinar, you're all muted right now, and we can't see you. And we'll use the Q&A feature right now because chat is disabled and I've been unable to enable it. After we're done with the presentation and Q&A, if we still need chat or the Q&A is not working, just raise a hand and I'll call on you and we'll unmute specific people for questions. So now what I'd like to do is turn the baton over to Joel, and let's first share my screen. Okay, Joel.
Okay, thank you, Lynn. Hopefully everybody can hear me. Lynn, can you hear me?
Yes, I can hear you.
Okay, great. All right, so I have a number of slides. I'm going to try to go through them relatively quickly so that we can also focus on addressing any questions you have. As Lynn mentioned, this presentation is going to focus on insurance coverages and insurance shopping, since obviously these are both challenges currently for a lot of communities around the state, but particularly those who live in more forested or brush-laden communities or areas that have had previous wildfires. So next slide, please, Lynn. So as Lynn mentioned, United Policyholders is a nonprofit. They came into being after the Oakland wildfire, the tunnel fire, and found that there were some of the volunteers that came together found a lot of people had a lot of questions about how to handle such major claims. A lot of times insurers didn't make things so easy for claimants, and that is still true today sometimes. So United Policyholders is totally based on grants and donations. So I'm here free to you, thanks to those grants and donations. And we also we table events at disaster assistance centers and local assistance centers after wildfires. Personally, I've done that myself for United Policyholders in Felton after the SCU fires, and I have done it in various other places around the state, but also did the same for the Department of Insurance. Next slide, please.
Just a minute. I'm having a, shoot. I'm sorry, I'm having a problem with my display. There we go. There we go. Sorry about that.
There we go. So the main issue here, and I will say I'm sorry that anybody wants to or feels they have to listen to an insurance presentation on their free time and give away an evening to talk about insurance. It's usually something we'd rather pretty much ignore. And unfortunately, it's a headline item nowadays. And, you know, we all worry about keeping our insurance and affording our insurance. So that's pretty common, actually, even countrywide today. So let's get into talking about what we need to do, how we can make the best of this difficult situation. Next slide, please. So there are homes located in wildfire areas that don't have much trouble getting fire insurance. So if you are able to accomplish this kind of setup, then you'll probably have no problem. If you're not, we'll keep going. So next slide, please, Lynn. So one thing I do want to talk about besides searching for coverage is making sure you have the right coverage. And I have to say that in almost every event, post-wildfire catastrophe event that I have been to work with claimants, they are significantly underinsured. So I can tell you that on my own policy that I had just a couple of years ago, my limit equated to about $250 a square foot. And many I've seen since might be around $300 a square foot. And unfortunately, in today's marketplace, probably the bare minimum you're going to pay might be $400 a square foot. It could be $500. It could be much more. It all depends, of course, on the difficulty of reconstructing where you live, but also in a big way on the size of the home and the types of finishes you have, right? The types of windows and flooring and cabinetry and countertops all drive up the cost. And while in a time when premiums are rising, you may not want to take any action that greatly increases the amount of premium you have, you should at least talk to someone about what a kind of realistic idea is of what it would cost to rebuild with your where you live, and at least bring your limits up somewhere to within the range of reason, right? So that you're not 50% underinsured or 40% underinsured. You want to at least get it close to your actual cost to rebuild. So while we don't like spending the money on insurance, unfortunately, it does make a big difference to have the right coverage in that rare event that you do need it. And unfortunately, those rare events happen, you know, to people every year. Next slide, please. So another thing we always throw in to advise people is to inventory your personal property. As a lot of people who had losses in the CZU fire, for example, found out, an insurance company, if you have a total loss, they can ask that you list down every personal item, a piece of personal property that you had that you want to seek claim reimbursement for. You have to write it down, how much you paid for it, when you bought it, and what condition it was in. So think of doing that for every little vase or chair or shirt or, you know, table in your home, and then receiving the actual cash value of each of those items, meaning the depreciated value and then having to buy that item and then get the replacement cost, the difference paid. It is quite a challenge. Sometimes insurers will pay out just your full contents limit, but they do that, they're more likely to do that if you can prove what you had. And one easy way to help you do that is to simply walk through your home, take videos of everything in your home, right, in the setting in which it's located, open your cabinets, open the drawers, in your kitchen, open your closets and film inside so that you can show, what furnishings you had, what amount of clothing, what silverware, pots and pans, things you may not remember if you had to start doing this incredibly detailed inventory. So at least saving that video to the cloud, and for with your pictures and other videos, at least gives you something you have to prove what your personal belongings were before a catastrophic event. Next slide, please, Lynn. So here's our kind of the main topic of the last couple of years for a lot of communities. If you've been non-renewed, and one thing I'll mention here, United Policyholders, where I work now, has a lot of information meant to be helpful to you about, what you should do if you were non-renewed. An insurance company has to give you 75 days notice before the termination of your existing policy of a non-renewal. And if you get that, you might want to start an appeal with that insurer. The insurer has to give you the specific reason for the non-renewal. So you can contest that if you believe it is mistaken. And so, you have a chance potentially of salvaging that renewal. But you should start shopping for coverage right away, because probably as you're hearing, if you're, talking to neighbors or if you're on Nextdoor, there are a lot of non-renewals going out, and it is a major challenge to find replacement coverage, especially if you're in a higher risk area. So you want to get right on it, even if you are fighting to get that renewal back. And when you contact, so you're going to need to contact lots of agents. Don't just, maybe your agent says, well, I'm sorry you got non-renewed, but I can place you with a fair plan. Don't accept that as an automatic. If your agent doesn't represent another insurer that can place your coverage, you need to start shopping other agents in your local area. Get recommendations of, who has other markets. And as noted here, you want to write down what agents you contacted, and you want to ask those agents which insurers they have represented. So you want to make sure you're doing a very thorough search before you concede that you might end up in the FAIR plan, which, is a possibility. I'm saying do all you can to stay out of the FAIR plan. Next slide, please, Lynn. Now, one other can be helpful tool is on the Department of Insurance website. There is a webpage called the Top 10 Tips. It's intended to help you look for coverage. I'll mention a couple of those items on there. Is the 800 number of every insurer, every admitted insurer. I'll talk about that later. Every admitted insurer that writes residential coverage in California. There are way more than a dozen or the 24 you might have heard of. There are like 80 insurers out there. Some of them very small, small numbers and obscure, but they're writing coverage. And you might want to call the 800 number of every one of those insurers and ask either for a quote, if they quote directly, or for the nearest agent. So you can contact and try and get a quote. Nearest agent could be in Ventura, but the location of the agent doesn't matter. It's really about, applying to as many insurers as you can, and doing a thorough market search. There's a chart there of insurers offering discounts. There's also an insurance finder tool that could be great too. But, odds are you're going to have to do a lot of legwork or phone work, I'd say, to find new coverage in this current marketplace. So don't give up and concede that you're only going to get in the Fair Plan policy until you've done your best. And, we all have different tolerance levels of shopping for insurance coverage, but do your best to try and find an alternative to the Fair Plan. Next slide, please, Lynn.
Hang on.
So just a quick note about the Fair Plan, since it has been growing rapidly. It is a basic property insurance, so it doesn't have many of the coverages that your current homeowner's policy would have. Basically, it is a fire policy. That's its main peril attribute, and it lacks things like water damage, for example, which is the second most common claim that homeowners have. It lacks liability coverage, which, while it's rare that people have liability claims, they can be very costly. For example, if somebody trips and falls on your property and you're somehow at fault, you don't want to have liability coverage. Odds are you'll never need it, but you should always have it. So if you end up with a Fair Plan policy, you're going to want to pair that with a difference in conditions policy. Some people call it a DIC, some even call it a wraparound, but it complements that very limited fire policy that is the Fair Plan policy with the other coverages that are more common that were part of the homeowner's policy you previously had. So a difference in conditions policy is pretty much a necessity for most homeowners. Next slide, please. So again, this is just to emphasize a Fair Plan dwelling policy plus a DIC equals something close to the equivalent of the comprehensive coverage you get in a standard homeowner's policy. Next slide, please, Lynn. So some add-ons. So a Fair Plan policy is kind of, I mentioned, pretty bare bones. There are some additional coverages, but they're not built in automatically. So you're going to want to add some of those yourself. One of them is replacement cost coverage. I kind of touched on that briefly about contents, for example. If you don't have replacement cost coverage, you have what's called actual cash value coverage for your contents. And that means your furnishings, your belongings, your clothing are all depreciated based on their age and condition. Of course, we don't know what their condition was, but if there's any evidence of when you purchased that table, they're going to take, okay, those number of years, they might depreciate it 5 or 10% for each year it's been in use. And then you only collect that depreciated value unless you buy replacement cost coverage. Unless you buy fair rental value coverage, you won't get a reimbursement for staying in the hotel or rental that you need to get while your home is being repaired or rebuilt. You'll want to increase building code coverage. The building code upgrade accounts for the difference between the codes in effect today and the codes that were in effect when your home was built. So, there's a lot of additional cost to the kind of foundation and vents and windows and roof types, for example, that current building codes require versus what the building codes were for when many of our homes were built. For example, my home was built in the 1960s. So it would need quite a bit of additional coverage to catch up to today's codes if it had to rebuilt. You want to add debris removal coverage. You want to add other structures coverage if you have other outbuildings that are of particular value. Next slide, please. So it's just the point is not all of these coverages are automatically built in as easily as they are into a homeowner's policy. I will mention that the FAIR Plan does give discounts for mitigation actions. There's I think it's a 10% discount for taking kind of those standard actions on your dwelling structure, things like the ember resistant vents and the Class A roof and the dual pane windows. And then there's an additional 5% for those things around your property, such as the clearance areas around your property and removal of flammable vegetation. So the same steps that probably apply for most Firewise communities that are a part of the Safer from Wildfire discounts or the IBHS discounts for a wildfire safe home, I think it's called. Those apply to the FAIR Plan as well. Next slide, please, Lynn. So one thing, hopefully we may all know at this point, is that insurers, besides using some data on age of home and the zip code you live in and the protection class of your fire department that responds to your community, insurers have started to use more data to segment or grade homes to determine how much they're going to charge and how much that or whether or not the home will be eligible for coverage. So I think we might understand here we have a little piece of the Santa Cruz coastline, and you see two red circles, and you might understand that between one red circle and the one higher up the hill, there's probably a rate differential because one's closer to the urban area and the coast, one's up in the more forested slope area. But there can be significant differences even between that lower red circle and the yellow circle. So every 100 yards can make a difference in insurer underwriting and pricing under today's use of satellite and aerial imagery. In fact, next slide, please, Lynn. In fact, a few years ago, it was just satellite imagery, like kind of similar to that last slide. Now, insurers are using aerial imagery, so it's more granular, more detailed look of your home. And one of the differences, for example, is they take in a more elemental components of your home. For example, as in this picture, they can determine whether tree limbs are reaching out over your roof line. So that's a no-no with a lot of insurers. And of course, to qualify for a more wildfire safe home, you wouldn't want to have your tree limbs reaching out over the roof. But they can look at a lot of things, the defensible space around your home. With these images, they really get a pretty good evaluation. It's not fully complete, but this is one of the reasons that we really don't have inspectors going out so much anymore, because insurers can make a lot of determinations just based on aerial imagery. Next slide, please, Lynn. So just an idea of how rates are kind of escalating over these last couple of years. This one kind of made the press. The State Farm got a 20% rate increase. Generally, insurers are kind of stay in the under double-digit range for their rate requests because there can be consumer groups that intervene in those filings to contest whether the insurer can really prove they need that much premium. But insurers have been able to validate these rate increases with the Department of Insurance. So State Farm kind of went for it and asked for 20%, and there are some others that have even asked for more. But just one thing to know, that 20% is a 20% on average to their entire book of business. And so there were actually some homes that got a rate decrease when this filing was put in place. Some homes in very urban settings and that had done a lot of mitigation work. But this 20% plays out differently, for example, in each of the zip codes of maybe some of the areas I'm speaking to now. If you look down at this chart, I have the 4 different zip codes lined up. The next line is across is how many policies State Farm wrote in each of those zip codes, excuse me. The average percent of increase, and you can see across there that Santa Cruz, the average increase was 27%, Felton area 36%, almost 37%, Aptos area about 29%, and 35% for the Summit Road area. And so all of these zip codes had a higher average than State Farm's 20% overall increase. And again, each of these percentages is an average. So for example, in Summit Road, while 35% was the average, somebody might have gotten a 20% increase. Somebody might have gotten a 50% increase, right? So it plays out differently based on zip codes and other components about the house. But again, it's always about averages. And this territory is just one of the items that insurers use as a scoring device for how much your premium will be, and the protection class of your fire department, the age of your home. And I mentioned those mitigation steps that you may or may not have taken all impact how much your actual increase will be. Next slide, please. So what matters in terms of your insurance coverage you want to have in place, whether you get to stay with your current carrier now or you're searching for coverage, you really want to have adequate coverage day limits. I mentioned at least within the range of reasonable to rebuild your home. You want to make sure it's replacement cost coverage, not actual cash value coverage. You want to make sure your policy has extended replacement cost coverage. Now, the FAIR Plan doesn't have that, but pretty much every homeowner's policy gives you extended replacement cost, which is a little buffer over whatever your limit is, usually from 15 to 25, but sometimes 40 or 50% above your current limit in case you end up being underinsured. So look for a nice, healthy, extended replacement cost percentage if you have an option among insurers. You want to make sure you have building code upgrade coverage. And again, that your coverage A is full. And notice that insurers have caps on certain items. For example, an insurer might have $1,000 cap on jewelry or a $1,500 cap on artwork. If you own valuable jewelry or artwork or other or business personal property, you have to buy special limits for those items. So you have to go in with your insurer and identify an item and how much of a limit you want for that item, such as an artwork. And know that homeowners policies do not cover flood, earthquake, mold, or earth movement. Earthquake coverage, I think most of us are aware you have to buy separately, but flood is another important one. With some of the rising rivers we've had in recent years due to the torrential rains, you'd have to buy flood coverage to account for that as well, or mudslide, for example. Next slide, please, Lynn. So you can only do what you control. So again, I mentioned, doing a real serious market search. If you end up underinsured, do all the mitigation you can around your own home. You may find you do it all and you still can't find coverage, but the important piece is you have protected yourself from loss. Bundle your home and auto coverage. So given how important or how costly your home insurance is, moving your auto there, even if you pay more with your current insurer for their auto coverage, that discount on the home insurance might make it a better deal than having your home and auto with two separate carriers. And I got to say, for everybody, typically you should raise your deductible. Many of us who have had the same coverage with the same insurer in place for more than a decade might have chosen a $500 or $1,000 deductible years ago when that seemed like a lot, but that's not a lot. You want at least $1,000, $2,500, or $5,000 or $10,000 if you the insurer offers it and you can handle that type of loss. Because the reality is you don't want to use your homeowner's policy to pay small or middling claims, right? You don't want to have a loss history until you need to have a loss history, right? Until something big happens to you. So raise your deductible to whatever level you can afford to deal with yourself, and only use that homeowner's coverage when you really need it. Next slide, please. So I'll mention quickly the Department of Insurance. It's been almost a year, I think, mandated that insurers integrate a number of discounts into their rating plans. Maybe a dozen were already doing it, but among those is a Firewise USA site or a fire risk reduction community. Every insurer had to file, will have to offer that discount. Maybe a few of those rate filings are in the works, but I think pretty much at least half of the insurers offer these discounts now, up from like a dozen just a few months ago. And every insurer will be offering these discounts most likely within the next couple months. So that's at the community level. Next slide, please, Lynn. And again, these are the common discounts that kind of anyone that's dealing with Firewise knows about. But a Class A rated roof, meaning basically not a wood shingle roof in particular, enclosed eaves, that's a little more challenging for folks. Means you can't have that kind of A-shaped eave where the fire can kind of raise up under your eaves and create heat. You have to kind of square those off. I know I have not done that, and that is a challenging thing to do or have done. Fire resistant vents, important not to have embers be able to penetrate the metal mesh grid of your vents. Homes built in the 60s and 70s have kind of too large of a metal grid to their vents, and so need to be replaced with a smaller grid vents. You need multi-pane windows, and again, then getting out to the maintenance of the property itself, 6 inches of non-combustible vertical clearance at the bottom of the exterior surface of your home. Next slide, please. And these deal a little more with property level, clearing vegetation under debris and decks, giving that 5 feet of combustible free zone that a lot of people talk about now. And that includes having your wooden gates removed, that if they attach to your home, replacing them with something non-combustible. That's one I haven't dealt with personally yet. It's a challenge for me personally. No combustible structures within 30 feet of your dwelling. And if you live in a more urban environment, you probably don't own out that far, but you want to have it any combustible area as far away as you do control. And for those in public, subject to Public Resources Code, you have to comply with the Section 4291 state requirements. Next slide, please. So I would ask all of you who are in attendance tonight, if you would please take our survey at uphelp.org. We have a home survey. There's just some general questions. We'd love to hear from you to give us a better idea of what's going on in the market and how people are faring around the state with these challenges. And I appreciate your time. And next slide, please, if there is one. I will mention again, there are a lot of sources of information, both on the uphelp.org website about things you need to do. Basically, all these things we just talked about, and you see somebody has replaced their wooden gate with a wrought iron gate, and brand new vents there, and non-combustible porch and driveway and surrounding of their home. So that's an idea of what we'd all like to own. Next slide, please, Lynn. And again, we have and are building a library of by-county materials, kind of just getting started, but we have some materials for every county, including Santa Cruz and Santa Clara counties. So take a look while you're on the UP Help website. RAP is one of our working groups for wildfire risk reduction and asset protection, an issue that a lot of people are dealing with right now. Next slide, please. And I do want to refer, there is some materials available from the state under the Listos emblem. Listos, of course, in Spanish means get ready. Listos guides are available for a number of catastrophe events. Super helpful if all free again, and some great resources to help with your kind of mitigation journey and your preparation for what to do in advance of a wildfire or any disaster. Next slide, please. So there we are, uphelp.org. We're here to help. We have an Ask an Expert page and all kinds of information on our website. And I think that sums it up, Lynn. Next slide.
Let's see. I think that's it.
Next slide is no slide.
All right. Thank you, Joel. So I'm going to stop sharing. And we've got some questions that are already started accumulating in the Q&A part that is working since our chat isn't working. So let's start with, I'm going to start with some pre-submitted questions just because people did email in some questions. We'll start with some of those and then we'll bounce around. We'll do some from the Q&A, and Pam Peck, I see that you have your hand raised also. So we'll try to get to everything. So the first question of the pre-submitted ones was, what is Insurance Commissioner Laura's office doing about the cancellation crisis?
Okay, well, he has taken an approach that I think it's a bit controversial, but maybe a lot of people are looking at this favorably. So insurers in California are kind of raising the issue that they just don't get enough premium through the California regulatory process to continue to write business in a high-risk environment. And this has been a battle for many years with insurers in California. There are a couple things that aren't allowed in accordance with California regulations. One of those is for insurers to pass on their insurance costs, called reinsurance, to the consumer. So that is something that they absorb now. They just, whatever they pay for reinsurance, they don't get reimbursed from that, from the premiums that consumers pay. The other thing is that the current regulations require insurers only to use an average of their own catastrophe experience that's loaded into the rates to account for future catastrophes. So insurers want to be able to pass through their reinsurance costs to consumers, and they want to use the types of wildfire risk models that look at where an insurer writes business and how much business they write, and predict the likely level of losses from a catastrophe that insurer will suffer on average each year, and that would be loaded into the rate. So Commissioner Lara's approach is to amend the regulations to allow both of those things to occur, for insurers to be able to pass on the reinsurance rates and for them to use these predictive wildfire loss models in order to bump up the premium. And he's hoping that brings insurers back into the market. It may or may not work, but even if it doesn't work, there will still be much higher premiums you can anticipate as a result of these actions. So it's a bit of a gamble that may not pay off. And it is one of those balancing acts between availability and affordability. And he's conceding affordability, hoping to achieve availability. So that's a thing within his control to do. It would require amending the regulations, but that's what he is hoping to accomplish.
All right, thank you. All right, another question is it possible to get homeowners insurance that has all the usual features except wildfire? Say if you don't have a mortgage and your home is paid off.
No. I'll make that easy. In California, fire is fire. And we don't allow insurers to distinguish between wildfire and fire, and even smoke. Smoke damage is fire damage in California. So no, there's no segmenting out wildfire.
Okay, thank you. All right. So for those of us who have been non-renewed, but our current policy doesn't expire until early 2025, when do you recommend we start applying for new insurance coverage? My concern is if I apply too soon, we're switching to a much higher policy cost sooner than we have to, or that the market may change. Is there a risk of not starting early, or what would you recommend to somebody who's being non-renewed in 2025?
Yeah, there's again no right answer, and those concerns are good ones that you are likely to be switching to a more expensive policy somewhere else. And there is the possibility that some of the homes that might be slated for non-renewal today, but haven't been given a formal notice, could end up that the insurer will offer renewal, provided these regulations change and the insurer is able to charge a lot more. But I feel the bigger gamble is not getting out there and finding coverage sooner, replacement coverage. So there's no right answer. And I understand, you'd be paying more, and there's no guarantee that you get coverage with another insurer and you don't get another non-renewal notice, a year later from that insurer. But, this is the place we're in. And, I think you're probably better off establishing, getting in the door with another insurer. One of the reasons insurers are non-renewing is because they are concerned about concentration levels. How many homes am I writing within a given vicinity that is subject to a single wildfire? and they're trying to thin those numbers out. And on the flip side, they would hope to maybe write business in areas where they have written less. And so, if you're, but some insurers that may not have written in, some of the areas that are getting non-renewed might be willing to write a few policies there because they're concentrated somewhere else. So you would want to get in with insurers before they reach their concentration levels and then are no longer offering coverage in your zip code. So no right answer, but I'd probably lean on replacing sooner.
Okay, the next one is, I'd like to ask if it's possible to be dropped from the FAIR plan for fire or wind. I've heard rumors this was happening, but would like some more clear information.
Yeah, the FAIR plan, we call it the insurer of last resort. There are no real eligibility requirements to get coverage there or stay insured by the FAIR plan, except that your house remain what's kind of captioned as insurable. And that means, like, if your roof degrades to some degree that, you're for sure going to have rain damage, or your electrical system is, for example, knob and tube, that used to be in Victorians, that is a much more likely fire hazard than a current electric system. The FAIR plan can non-renew you, but they can only non-renew the most hazardous homes. It's not for wildfire risk. It would be because of some failure of the home to comply. It could be that the tree is on touching your roof, for example. So if you mitigate the home for those components, the FAIR plan has to renew you.
Okay, a similar one. I recently got a FAIR plan quote through an insurance agent. It's almost 2 times as expensive as what comes up on the CA FAIR plan's own website calculator. I put my address into the website calculator. Is this to be expected that a quote from FAIR plan through an insurance agent to be so much higher than the website calculator?
No, they should be the same. So, I would make sure that that the agent isn't talking about including something else like a DIC in combination, or, make sure the agent prints off or makes very clear what kind of coverage he got a quote for, what the limits are and additional coverages. It could be he's added some of those coverages that I mentioned you should add if you buy a FAIR plan policy, and maybe you're not. But, the only other reason there would be a differential besides the coverage issue is if the FAIR plan's calculator were not up to date. Hopefully that is not the case.
Next one is a DIC coverage the same as an umbrella policy?
No, it's an umbrella is a totally different thing. An umbrella policy typically refers to a level of liability coverage above the coverage that comes with a homeowner's policy or a rental policy. And it would also, so it's a liability coverage typically, and it also would extend above your auto liability limits. So there it is typically for property or bodily injury damage that you cause at a level that exceeds your homeowner auto limits. So it's umbrella is a totally different thing. It is the DIC is kind of the wraparound. It's even called that for a fire policy. That is the FAIR plan is really kind of more of a umbrella-like coverage. It's not called an umbrella. DIC, difference in conditions policy.
Okay. Some of the agents I've contacted tell me to wait until 60 days prior to my State Farm policy expiring in August. Should I start now to get quotes and information if I find a good policy, or should I wait? And I think you sort of already answered this one.
Yeah, I should mention, there can be a short rate cancellation component if you terminate your policy early. It can be, so whatever your return premium would have been for that portion of the policy that you didn't complete, they might deduct 10% from your return premium for a short rate penalty. So that is another reason, you could ride out the current coverage. But I'd certainly be shopping already for that later effective date. So if you still have, and again, an insurer has to give you 75 days notice before they non-renew. And typically insurers don't tell you any earlier than that. But I think State Farm has advised some people that it's non-renewing earlier. I think you might ask the agent, given that information they've shared, whether they would waive the penalty for non-renewing early.
Okay, I'm going to try to go to somebody with their hand up. Pam Peck. Pam, can you unmute yourself if you're still there?
Yes.
Fantastic. You're live.
Excellent. Thank you. Thank you, Lynn, very much for setting this up. And thank you, Joel. This is excellent information. I'm on the board of the Fire Safe Council for Monterey County, and we have many Firewise communities. And you've done an excellent, you have an excellent explanation about the FAIR plan, not to use it as your primary source for insurance. But most of our people don't understand who funds the FAIR plan and where the money comes from. They don't understand the connection with the existing insurance companies. My question, could you explain that? And could you also explain, if the insurance companies pull out of the state, what does that do to the funding for the FAIR plan? I do have another question, but I'll hold that for later if you have time. Thank you.
Okay, yeah, I can start with that. So unfortunately, we're having to learn a lot more about financial background of a lot of insurers. So the admitted insurers, the State Farms and all states, and about 80 other companies you may have never heard of, American Modern, or there's just a number, Aegis. They are backed by the California Guarantee Association. So they pay into a fund. So if one of those, they're called admitted carriers, goes insolvent, there is a fund to pay for that insolvency, contributed to by all the other admitted insurers. And we did have an insolvency up in in Paradise. I think it was Merced Property and Casualty, went broke, paid out so many losses, and those other admitted carriers stepped in and funded the rest of the payments. For the FAIR plan, it's actually all the insurers are the support for the FAIR plan as well. So if the FAIR plan were to become insolvent, in other words, spend all the reserve money it has today, then there would be an assessment on all the insurers that are admitted insurers in California to pay the FAIR plan's losses. It's one of the reasons that some of these insurers are becoming concerned about the size of the FAIR plan, because the FAIR plan is a liability for all the admitted carriers as well. But you would be, guaranteed that your loss would be covered if you were with the FAIR plan. The issue really comes in terms of more of a concern, non-admitted carriers or surplus lines carriers. There's a list of those on the department website. Kind of the better vetted ones are on something called the LASLI list. I know it's cumbersome, LASLI, but they're surplus lines insurers. They have strong financials. Many surplus lines insurers do, but you want to check out their financial rating. Usually there's something called a best rating. And if they go broke, there's no backup plan. So the FAIR plan has a backup system, and your admitted carriers have a backup support financial system.
Great, thank you. I'm going to go to one in the Q&A, and then I'll go to another hand up. Somebody asked, is it worth looking at non-admitted insurance carriers? I think that means out-of-state carriers. For those of us being cut by State Farm, every carrier I've contacted in California is not writing new or renewing.
Okay, so again, I'll mention that top 10 tips and the link to the 800 numbers of all the carriers that are admitted in California, to make sure when that when you say I tried them all, that you really have tried them all, right? Because there are just a lot you might not have heard of. And if you contact 10 agents, any one agent might only represent 4 or 5 carriers. And if you talk to 2 agents, 3 of those carriers might have been the same. So try to be with an admitted carrier for the reasons I just mentioned. Not only is there more guarantee of their solvency, but also their rates are regulated. So the rates you see today are very likely to be similar, at least, to the rates you'll get at renewal, although obviously we're seeing some big increases. Surplus lines carriers can be great, but they can charge whatever they want, and there's no solvency guarantee. So again, look at their financial situation. Are they at A rated or A minus rated? And if they are, they're likely to be solvent and be able to deal with as much as any other insurer. But you really don't want to go there if you can find an admitted carrier.
Great, thank you. All right, I'm going to go to Jamie. You have your hand up. I'm going to unmute you. Are you still available?
Yes, I'm here. Can you guys hear me okay?
Yes.
Thank you so much for your time. I really appreciate it. The last 2 weeks, I've reached out to about 40 insurance companies. I have 6 agents looking for me. I've gotten 1 quote from a surplus company for $17,000. And the California Fair quote is coming in at $10,000. Today, I finally found an agent who listened to my needs and was able to scrape the bare bone, like the California Fair policy, down to just absolutely bare bones coverage. And it was coming in at $2,000, but when we go to like the last page to submit the application, it jumps to $5,000 with no, it doesn't give any explanation as to why. I'm curious if you've heard of this at all.
No, I haven't. I don't know why any rating system would do that. I assume your agent can't explain it
Nope,
either?
they said they've seen it before and they have no idea why, and they say it happens sometimes and not others.
Yeah, unfortunately, there is a direct line to the FAIR plan, which I think
Okay.
they answer one call every 10 hours or so, but because there's a lot of complaints about their number.
Yeah.
But it should be something your agent is able to research and contact the FAIR plan to find out, to do that explanation. I don't know why you'd get such a distinction between the quotes. I would say, again, to go back to some of my comments earlier, a bare bones FAIR plan policy is really a bare bones thing, right? Its sole purpose really was to satisfy a mortgage requirement more than,
I mean, that's
really.
we're at the point of losing our house. I
Okay.
mean, I can't pay $10,000 a year. Like, that's insane. And
I appreciate
I don't
that.
know what to
And
do.
yeah, you can only search and find the cheapest you can. So, for anybody, I say, do what you can, raise your deductible as high as it will go, and as that you can, suffer a loss to get the premium down. And I understand reducing the coverage to something you can afford is always a key to, what you're going to choose. So, but I'd have the agent check with the fair plan. And are you purchasing a DIC or gonna forego that?
Jamie, are you still there?
Yeah, sorry, it
Okay.
muted me again. I mean, we're just trying to figure out what we can do. Right now, the fair plan is coming in with a $20,000 deductible and basically just covering the balance of our mortgage with no additional coverage is coming in at $5,000.
Okay. Yeah, that's, I would say, one thing is typically your lender can't require that you insure to the loan value. That you only have to write your fire limits to the replacement cost of the home. So, for
So
example,
who determines that? Because I've called the insurance commissioner, my mortgage company, and I've talked to insurance agents, and no one can give me like a straight, solid answer. They just kind of give this vague answer about, oh, well, the insurance company calculates it. But it seems very open to interpretation these days.
yeah, typically an insurance company will give you the replacement cost of the home. And many insurance companies really don't want to write any less than the replacement cost of the home. In fact, that is pretty much a standard. The reason being, most losses aren't total losses. So, they don't want to be providing you the coverage for the most likely losses without getting that full premium. But a mortgage company, generally speaking, I don't know exactly how you'll resolve this, but your mortgage company, you could buy a home for $800,000 and the rebuild on that house is only $400,000, but you'll have a $700,000 loan. The mortgage company can't make you have a $700,000 policy just because that's their loan. The collateral is the home. So you have to cover their collateral. So you have to have enough coverage to rebuild the dwelling structure.
Okay,
So that's,
I don't think we're that far off.
Okay. I'm just
All right.
trying to explain, and
Okay.
I'm not trying to, go anywhere else than tell you what the kind of basic requirements are, and you can only do your best with, what you can with it.
Okay, I'm going to do a real quick time check. And that is, Joel, how much more time are you willing to spend? Because there's at least 20 more questions. Do you have another 15 that would you?
Sure.
Okay.
Let's see. Let's try and do them all.
Okay. All right. Is it possible to get earthquake insurance without also having a homeowner's fire policy?
Wow, that's a good question. I've never been asked that. I think you can. There are specialty markets that offer that coverage, but of course, the California Earthquake Authority is one. I'd at least reach out to them and see if it's possible, since they are an earthquake-only insurer. But I've never heard of anybody purchasing that coverage. But I guess if I was on the fault line in Hollister and wasn't worried about my house burning down, but I was about an earthquake, I've never heard it. I don't know, but there's no reason why they shouldn't, I would say. You can't even fake an earthquake, unlike other perils. So.
All right. And if somebody wants to know where they can get information about the California Fair Plan, is that through an insurance agent, or do you go to a website to get Fair Plan information?
Yeah, there is California Fair Plan does have its own website. It does have a pretty good amount of information, but there are a lot of independent agents that represent the California Fair Plan, including State Farm and Allstate agents. A lot of agents don't work with the Fair Plan, but a lot do. So try and find one that is very familiar with it. Even I, before this, I talked to a gentleman in Los Angeles. Carl Sussman was an agent, and he knows a lot about that Fair Plan. So there definitely are agents you can find who definitely specialize in knowing what the FAIR plan does, because that's where they're having to place a lot of coverage. So you can check their website. I will say their website appears geared to trying to give the least assistance they can. So unfortunately, you probably need an agent to help you.
Okay, we have Thomas Setfin asked, can Joel explain that penalty again?
Maybe the short rate penalty. So for example, if you had you paid $1,000 a year for your homeowner's premium, and then you wanted to terminate it 6 months early, they would owe you $500 back if it was prorated your return. But typically there is what's called a short rate cancellation. So they'll usually, instead of getting 500 back, you'd get 90% of the 500, right? So you'd lose $40 or $50 in that scenario, excuse me. So that'd like be a 10% penalty taken from what your return would be for not continuing through to the expiration date of the policy. So that's a short rate cancellation charge. Typically 10% of the amount that you should be returned based on the date you're canceling, but for that penalty.
Great, thank you. Bruce, you have your hand up. Do you want to unmute and?
Yes, hi. Hi, Lynn.
Hi.
I have a question about what's the best way to get a determination of areas needed around my building for fire resistance? Like what areas need improvement? You know, and it's kind of like some of the presentations that are going around that talk about on an individual household. I recently moved into a senior center, which has 400 people living in basically multiple attached apartment buildings in Cupertino. And there's a hesitancy to look at what the threats of wildfire even are. And we're 200 yards from the extreme fire danger, according to the CAL FIRE map. So I'm just wondering how can we improve our resilience in the face of potential wildfires? Plus, how can we assess what the likelihood of a wildfire this fire season might be? And maybe over the last 5 years, how much has that been increasing to get people to take it seriously?
Yeah, so you might look at that set of discounts that insurers are obligated to offer in terms of what to prioritize for things to do around your buildings, of your residential buildings. I don't know that, I guess these would apply to apartments or townhomes as well. But really, your local fire department can help. Typically, Firewise leadership typically is very helpful in this regard. Again, looking at the things that are being discounted, look at the IBHS, it's called. Well, I'm blanking on what those mean, but has a wildfire prepared home program that you can look at. There are a number of standards. Safer from Wildfires is another set of standards, all of which identify very similar projects in terms of creating defensible space around each building, the Class A roof, the ember resistant vents, the dual pane windows. They're very common from one group to the next, removing trees that are, again, edge over your roof. It's really about separating the brush and vegetation that bring wildfire on a path to your structure. is really the key, and that's what Firewise communities typically focus on as well.
Thank you. Denise Gluhan, I see you have your hand up.
Let me unmute. Hi, Lynn.
Hi.
Thank you for this presentation.
Hi.
Quick response to that last question. Firewise, and also reach out in Santa Clara County to Fire Safe Council and look at a home ignition zone inspection. I know you said it's a townhouse, so it might be a little different, but that's something that's offered here locally so that you can have that done, and it gives a report on the mitigations and home hardenings that are recommended. That might be a starting place just for some of the people that are in. I know Santa Cruz County has it also, but that's something that you can look at as a starting place too. You can also, if you do the Firewise, there's a lot of template offerings through that you can go through and utilize yourself to get, information if you don't have that benefit available to you. Thanks.
Denise, you had typed in one other question in the chat. Did you want to share that?
Sure. I just wondered, we have obviously this peril that insurers have had for wind and rain, things like that. One of those solutions has been for earthquakes, the earthquake insurance, single source purchase, and then flood insurance if you're in a floodplain. Do you anticipate a possibility that you can single insure wildfire risk similar to earthquake insurance, where you purchased, just wildfire risk that way instead of it being such an effect on all policies, or is that just going to be so expensive it wouldn't be practical?
Yeah, I would say I don't expect that will happen because it can be very hard to parse out, a fire in a field that burns 3 homes or 1 home, but is obviously a fire that got out of control in vegetation. Is that a wildfire? I mean, you'd be drawing some pretty arbitrary lines. And I think there's the sense that, that people might then not choose to have a coverage that is probably more relevant than earthquake coverage might be in California. And earthquake coverage is pretty relevant, but almost no one purchases it. So, I mean, we've tried to avoid trying to identify an ignition source as a determinant of what the peril is, because it's kind of gets subjective of where you draw the line, I think.
Cool. And then one other follow-up question. I know that basically the FAIR plan covers like the pillars of ignition sources, like, lightning, fires, things like that. Where does arson fit in? Does that in the DIC, or is that in the FAIR plan coverage? Thanks.
Yeah, arson is covered, I think, under any home, because again, it's fire, unless you set it yourself, in which case it's crime and not covered. So I don't think there's any exception for arson. I could be wrong, but I don't think there is. Again, unless you do it yourself.
Good question. Okay, I've got one that was submitted prior. Do you think going forward, insurance companies are going to require wildfire mitigation minimum standards for new or existing policy located in the WUI? The California Board of Insurance has proposed the Safer from Wildfire standard, whereas the IBHS has created the Wildfire Prepared standard. It seems that Farmers Insurance is now requiring the Wildfire Prepared designation for renewals.
Yeah, well, an insurer gets to set whatever standards they decide, as long as they are based on objective risk of loss, right? They can't make you paint your house blue to be eligible. But if it's something related to a peril, they can require it, and they can change it at any time, right? They could say, okay, we write wood shake roofs, and 2 years later decide, nope, we're not writing them anymore, and non-renew everybody that they'd written that had that. So they can impose new requirements at any point in time, and they can reduce some of those requirements. Of course, we're in a place now where they are imposing more new requirements, and most of them are fire related, because that's where the biggest losses have occurred. So they can go with whatever set of standards they want, or a subset of them, or an expansion of them. So I can't really say that, you know, if I do the IBHS, will I be eligible for coverage everywhere? No, because some insurers may not accept that. I think the state safer from wildfire ones includes the eaves, which I don't think the IBHS standards do. So there's one difference there. You know, whether they really would need you to do your eaves or not, I don't know. Most of the other items are becoming requisite for new business, and I'm guessing over time will be requisite for renewals as well for those who have an exposure. And there probably are some communities that don't, you know, even one of the perils insurers do deal with is fire following an earthquake. And so even an urban area that has limited wildfire risk generally can benefit from mitigating the chance of wildfire spreading to their home. So I'm guessing the mitigation actions are going to be pretty widespread requirement for all insurers, for all homes over the next few years. And of course are already in place for pretty much anywhere with any level of risk of wildfire as we see it.
Right, we've got one more from Allison. Does requesting an increased standard insurance coverage level to a reasonable rebuild rate make it more likely that you'll be canceled? Also, how do you approach that conversation with the insurance company if they disagree about rebuild costs?
Yeah, I had this call myself because I believed I was underinsured. I would say I don't think that there is a link between the customer service and the coverage, you know, and the coverage decision making. The only issue there is, you know, if you're going from a $800,000 replacement cost to a $3 million replacement cost, yes, you may have created a concentration of values concern. But you know, if you're going from 600,000 to 800,000, I don't think that's going to impact whether the insurer will write you or not. But you know, if you got that non-renewal call at the next renewal, you'd go, it's because I increased my coverage. But you're never really going to know that. And so I think it's important to, again, get into the range of reasonable so that it is responsive. Now, one thing you get every other year by law from your insurer is an estimate of the replacement cost to rebuild your home. So they give you an estimate and it'll show you debris removal, architects and planning fees, you know, the cost of the structure. So it gives you like a 4-component breakdown of how it arrives at that number. And you might look at that and say, wow, that's a very thorough evaluation. It must be right. But we still find after a catastrophic loss that really the majority of people are underinsured. And there doesn't seem to be an incentive why an insurer would underinsure you because they lose out on premium, but somehow they don't seem to keep up with California construction costs. So, you know, at least marginally increase it to somewhere you're comfortable. If you're worried about, you know, that sticking your head above the water with the renewal decision, you know, you have to use your own judgment. But if you're in the wildfire area, I mean, you want to have at least something approximating what you'd need to rebuild.
Thank you. Elo, you have your hand up?
Hi, thank you so very much. And Lynn, I want to thank you for supporting us in Fall Creek and all the others that you do. You do a fabulous job. And Joel, thank you so very much. I found out today I was not being renewed. So this is very timely. So I have two questions for you. One is you advise on balance not to wait to shop. But if I can only get the fair plan now and my non-renewal is going to happen in December, am I still better to go ahead with the fair plan or just hang out with State Farm until I get the non-renewal? And then the second one is kind of personal here is, can you give clarification about the structures and the CDI mandatory discounts? It's saying it needs to be 30 feet from the home for like a shed, for example, or a shop, but I can't be 30 feet from the home because then I'm within the setback from the street. So does that mean I can't have a shed, or what does that mean?
Yeah, so first, your first question is, the fair plan is always going to be available to you, provided it provides high enough limits to satisfy your needs. So there's no need to drop the State Farm policy before it expires and move to the fair plan. They're not going to be saying we're over concentrated and we're stopping new business. They will be there for you. So the thing you want to do, but if you have a fair plan quote now, that's nice, but you don't need to use it until your coverage expires. So you want to use this intervening time, the 75 days between the time you receive that notice and when your policy expires, to find a different insurer than the fair plan. Hopefully an admitted insurer, again, from that list of the 800 numbers, you'd see all their names, or just by calling as many agents as possible and see who they represent to make sure you're really getting out there and finding, replacement insurer. But leave this fair plan move till the date, the renewal date and your expiration date of the State Farm policy. But get shopping now is what I'd say. And hopefully you won't have to settle for a fair plan policy. The discounts, and actually the fair plan offers kind of these same discounts, are not a thing where you have to do them all to get the discount. Each one is a separate discount. So if you can't achieve the having no combustible structure between your home and your property line, which a lot of people can't, they have a barn or a shed or a garage or something, then you just won't get that discount. But you can still get all the other discounts for having the ember resistant vents and the Class A roof and the double paned windows and the 6 inches of before the combustible materials on the siding. You can get all the rest of them. So it's do what you can from that list.
Fabulous. Thank you.
All right. Thomas asks, are fair plan rates going to go up at any point soon?
Fair plan rates are likely not to rise as quickly as the main admitted carriers are going to rise over the next year or so, assuming the commissioner moves forward with these premium increasing measures that he is looking to do. The fair plan already uses projections of wildfire losses to set their rates because it's exempted from the rating regimen that the other admitted carriers have to follow. The only way their rates are going to increase dramatically is if they have a loss, a wildfire loss that takes out a lot of their homes. So they have that, risk, since they do write a lot of business in wildfire risk laden regions. So their risk is high, and thus the chance of their rates increasing at any point in time is high. But between, over the next few months, they're not necessarily going to go up based on, what they have in place today. But they are generally much higher because you're in a very concentrated group of homes with the highest risk and many times the most losses. And as I mentioned, you are paying for the predictive nature of what wildfire models say the FAIR Plan could lose in a given event. So it's very minimal coverage for a maximal price, essentially, unfortunately. But a lot of states have no FAIR Plan. And when you're non-renewed, you're really out of luck in a lot of states. You really don't have options. So bad as it is, we are fortunate to have the FAIR Plan.
All right, we've got one more, I'm gonna do one more question, although there is a backlog of more, just to respect everybody's time, and then we'll wrap it up. So this one is from Lynette. My State Farm agent says that they don't write FAIR Plan or offer wraps. I believe Farmers does. Is this insurance company specific or broker specific?
Yeah, a lot of that's going to be broker specific. I think I don't know that many farm or state farm agents do deal with the FAIR Plan. There are a lot of agents that don't deal with the FAIR Plan generally, so it could be just yours. And you might call a farmer's agent who also doesn't deal with the FAIR Plan. You do have to look around a little bit. I think the FAIR Plan has a broker finder tool on their website. And again, there are some coverage finder tools as well on the California Department of Insurance webpage. Look at that top 10 tips to help you, shop for coverage. There are 10 different tools there intended to help you.
Okay. All right. Thank you very much. And just to respect everybody's time, we'll just wrap it up. Joel, is there any final thoughts that you'd like to share with us?
Yeah, there's so much uncertainty in this market. I just have to remind people, to do your best, buy the coverage you can afford. We had a conversation earlier about, maybe you can't buy full coverage, but so do what you can afford. Don't take this as like you did something wrong. This is a statewide and actually nationwide issue with insurance, and you can only do the best you can do. So, make your best effort at calling lots of phone numbers and see if you can get a coverage. And if you can't, then the FAIR Plan isn't a sign of guilt or failure to, work as hard as you could to find coverage. It is just a fate that unfortunately awaits a lot of us until we kind of get better control over our fire risk. And for that, we really have to be grateful for all the Firewise communities for the work you're doing. And, we always say to people, every little bit you do for your house, you're also doing for your neighbor's house. So it is a true act of kindness to take any mitigation action. And so do what you can, control what you can. And I wish the best to everybody. And I'm sorry you had to listen to me go on and on for an hour and a half. So
No, we really appreciate your willingness to share your time and expertise with us. And so, and for everybody who, I will send a copy of this recording and a copy of Joel's slides out to the Southbay Firewise Partners email distribution list. And so for those of you who got this Zoom invitation from your Firewise leaders, they're the ones that will have a copy of these slides. So thank you, everybody, for all your fantastic questions. Joel, thank you so much for helping to educate us. And have a good evening, everybody. Thank
thanks
you.
for having me.
Right,
Bye.
bye-bye.